Everybody, welcome. My name is Jordan. So, quick summary of top 5 JSE dividend stocks if I were looking today. Quick disclaimer, firstly, none of this is financial advice. Please don't treat it as such. And there are only two of these companies which I own. I'll tell you that at the end. So take a lot of what I say with a pinch of salt. This is just a high-level look at some of the companies and not a recommendation. First up is MTN. MTN sitting at 6.5 dividend yield. It's relatively cheap relative to many companies globally, but especially within South Africa. It's a borderline monopoly for what you get into Africa. There's fantastic customer satisfaction ratings, probably the best amongst the rest of the telcos. And most of the midterm money, in my perspective, has been made around the last year. The turnaround story that kind of came out middle of last year, with them selling off assets in Africa and paying down debt. The stock has done fantastically over the last couple of months, last like 6-12 months. So the easy money, quote unquote, has been made. Growth coming now will probably be either sentiment driven around the kind of 5G rollout, or broader African growth narrative and the potential for like a super app and distributions that can piggyback off of their existing network. Alternatively, you could have a value unlock, which comes from a spin-off of their fintech segment. That would be really interesting. They have a fantastic fintech segment, and at the moment it's not big enough in terms of relative size to move the needle much. But if you unpack it and there was a spin-off, I think that could be quite a windfall for shareholders. Second up, we have CMH, Combined Motor Holdings. Fantastic management. They are in the used car sales business, which is a very fragmented market, and there's very low customer satisfaction scores across the market. So when you have a company like CMH, or like, for instance, We Buy Cars, that it comes in and is able to offer a little bit more compelling value proposition than hunting a car in Gumtree, customers typically like it. So even with the cyclicality of SA car retail, CMH has never fallen into a loss. They've got pretty legit unit economics, and they have been slow, unfortunately, on the tech uptake. So currently they're sitting around 9 times free cash flow over the last 5 and 10 years, which is the average over the last 5 and 10 years. So if you forecast this out, even with zero growth and a 4% EBIT margin, then on a sum of the parts basis, they're worth roughly 3.2 billion, which is about 130% more than where they're sitting currently in terms of valuations. So you can see there's not that much risk. It's kind of a value play, but they're sitting at a 12% dividend yield, which is ridiculous. And so you basically get paid to sit there and collect the divvy while waiting for some value unlock catalyst. That catalyst might come in the form of the fact that used car prices have been on a tear at the moment, just recently over the last 6 months, partially due to a broad nature of factors, but also the stimulation checks and stuff, the quantitative easing that's come from a lot of the governments worldwide, putting money in people's pockets. Guys have decided perhaps to raise to upgrade their cars. However, caution, used car sales are a very cyclical industry typically, and so for everything that goes up, there will be something that comes down. Now, the third company is Bellwin Properties, and this is sitting at an 8% dividend yield. Great management team, strong entrepreneur in Stephen Brooks, who's the founder, kind of brought this thing up from a very, very small company, and now it's sitting today pretty decently sized. He's got ambitions to take it to kind of one of the top 40 companies in South Africa. I think that's laudable, but there's a way to go before then. Anyway, so the management have great cash management. They've really been quite prudent in terms of keeping costs low, and they have a lot of skin in the game. Stephen Brooks especially owns a sizable chunk of the company. There's a long pipeline of properties, so these guys have like stacks and stacks of runway still to grow. In terms of sales, there's a resilience that affords. There's very little debt, and management's shown pretty good adaptation to kind of the changing different market circumstances. Firstly, as South African consumers get squeezed in terms of like job losses and whatnot, everybody looks to buy cheaper houses, and so management has moved largely to cheaper houses and are selling more towards the lower end. That's been pretty good. They've seen some nice growth in those sales, as well as the fact that they've now started pushing things online. With COVID, it's hard to follow the standard procedure of kind of going to visit a house and having your usual sales pitch and all of that stuff. So they've moved a lot of the sales process online, which, whether or not it's been taken up, is it's good. I don't know, to be honest, what the uptake is like, but I think the important aspect is that it shows adaptability from management. Now, what's pretty cool is they've returned capital to shareholders at a roughly like 15% ROIC, which is quite nice. That's very decent, especially for a company that's as asset heavy as Bellwin Properties. However, their real competitive edge lies in the brand. They've come to dominate the mind share of a lot of kind of young up and coming people in the low cost but quality markets, specifically around the Joburg areas. And the Manyaka development has also got it's a nice little gemstone that they have, which I think is quite hard to replicate from an IP perspective and a licensing perspective as well. So the fourth company is Signia. Now, Signia is an asset management company sitting at a dividend yield of roughly 7%. Very cash generative, great balance sheet, rock solid, hyper scalable. And because they're focused on passive investment vehicles like ETFs and whatnot, they are more scalable than kind of relative peers like 91 or Coronation or those others. And they also have the benefit of passive investing has a massive tailwind in terms of retail adoption. There's a lot of guys who are now looking to, rather than just give their money to a manager, stick it in ETFs because of its lower cost and achieves roughly similar or better returns. So management's also had a good track record from Signia's perspective. Magda, I don't know how to say her surname, was the CEO and founder. Took this thing up from way back when. Magda, I think, used to work at Coronation, if I remember right. She was one of the first early employees there. Long history, quite divisive character, but aren't all good founders. She's recently stepped off, actually, and she's given over to David Houghton, who's the new CEO. He has been running the show, I think, materially speaking, for the last couple of years. So I would say this step off from Magda is probably more nominal than anything else, but we will have to wait and see. Now, being capital light, they are quite scalable, as I mentioned. Good unit economics. I think what's also interesting with Signia is it's quite tough to make an ETF. The regulations and kind of loopholes that you've got to jump through when entering a new market they're quite a hurdle. So it's not as though people can just replicate the product that simply, which makes their offering to Africans quite differentiated. They can't go so much overseas because overseas people have already done the whole loophole jumping process, and there are much more scaled and equally competitive peers already in that market. So from Signia's perspective, it's a marketing game in Africa, and then also expansions in terms of the product offering. They're trying to find different niche markets that they can tap into, like their fourth industrial revolution fund. Satrix has come out with the China ETF, which is quite an interesting one, and I don't think Signia has a direct competitor. I think Signia's got an offering for Japan, but their game at the moment is to try and get the niche markets and give South Africans access to that. So the final company is British American Tobacco, sitting in a dividend yield of 8.2%. Just a quick comment, it's absolutely wild that these companies are sitting at these yields. I mean, these are bond level yields, which on resilient companies, I mean, you're capturing upside for free. An 8% yield is a very good return. And then any upside that you get in kind of a sentiment re-rating or whatever for a company like that, that's just on top of the 8%. So ethics aside though, BATS trades at around 6.2 times free cash flow, roughly 9 times unlevered, and can raise prices at between 5 or 7% per year. So they've got quite a bit of pricing power, as you'd imagine, from a tobacco company. I mean, it's really hard to get rid of the products. They also grow, I mean, this was crazy. They grew cash flow around 12% during a pandemic, which if you've known anything about the lockdowns, companies like South Africa, which is not the biggest part of their portfolio, but not the biggest kind of revenue segment for them, but I assume other countries had similar effects, had a lockdown, and these lockdowns would have really crimped the potential that they have for sales growth. So the fact that they grew cash flow around 12% is genuinely remarkable. And interesting, they have a activist shareholder, Kenneth Dart, who's got a 5% position in the company, owns 5% of the company, which is something crazy, like I think, and don't quote me on this figure, but I think it's like 70% of his net worth. So he's got a good track record of going into companies, taking an activist role, kind of assisting or pushing management in a particular way, and then unlocking value for shareholders there, which is quite nice, could act as a bit of a catalyst for the company. Now, where BATS gets interesting is they have a lot of optionality in the 52% year-on-year growing vape and oral business. I mean, that's wild. The fact that there's a little stub of BATS that is growing at 52% per year is crazy. They have fantastic distribution, which I think maybe Philip Morris competes with them in distribution, and I do like Philip Morris as a quality player, but better than BATS. But neither tobacco stock holds personally that much appeal for me. I think the excellent market is the distribution strength that these guys have, or the excellent opportunities, the distribution strength that these guys have. It's quite hard, even for a vape startup, to compete with this level of distribution. Just by way of anecdote quickly. So, interesting fact. A couple of years back, BATS had no presence in vape in Canada. And then they decided, okay, well, they have the capacity for distribution there. And there was another smaller players who were dominating the market, which was still then a small market. But since BATS decided that they were going to punt distribution there, they were able to leverage the channels and really, really grow their vape there over 2-3 years to become the leading player. And that's kind of, I would say, it's typical for a company like this that has the branding and the distribution to be able to scale like that. So they're actually number 1 or 2 in most of the Western markets at the moment. I don't know vaping market that well, if I'm honest. So do take all of this, as I said, with a pinch of salt. These are just some of the numbers on BATS. At roughly 15% free cash flow yield, you're getting a 15% return if there is no growth in the company. And given the current multiples that they're trading at, there's very little downside. They've also got the pricing power to kind of cap the downside. Cigarettes are not going away anytime soon. If they start repurchasing shares in addition to the divvy, then you can probably compound the intrinsic value pretty quickly for shareholders. So an overview of a lot of these companies is there's a low risk to a high dividend yield. I know there's concerns around secular decline and whatnot, but broadly speaking, these are all good companies with good management, and barring maybe CMH, the industries are not in such secular decline. Tobacco perhaps also, but I think with vaping, there's a offsetting effect there. So you have many ways to win, even on top of the divvy. You can have multiple expansion, growth in the underlying business, and then you have the divvy on top of that. So quick recap of BATS though. You have pricing power, capital intensity, and recurring purchase. That's basically a SaaS model for a industrial era company. So those are the top 5 companies that I would recommend for JSE dividend plays. You have MTN, Combined Motor Holdings, Bellwin Properties, Signia, and British American Tobacco. Special mention goes out to Lewis, which I was pretty bearish on last year. Still don't own the company, but I will openly admit that I was wrong about it. Dividend yield of 10%, trading at around 3.5 times unlevered cash flow. I mean, that's just unbelievably cheap. They, for those of you who don't know them, are a specialty retailer. They offer kind of financing and insurance on products that they sell, and then they sell mostly your furniture and buy now, pay over time kind of model. They've got a very comfortable financial position. They've reduced debt levels quite a bit over the last couple of years. They took out a bit over COVID, but they've since paid that down nicely. Good cash flow, strong earning yields. I mean, you can see that with 3 times cash flow, whatever it is. And interestingly, so credit regulations are pretty strict for lower LSM targeting companies. Understandably, we don't want people to take advantage of poorer and less privileged individuals. So courts have been quite strict in finance and lending practices in that sphere. However, they've judged repeatedly in favor of Lewis for the credit and competition-based litigation suits. So Lewis is sitting in quite a resilient position relative to potential regulation. Now, they've grown about 4% on average, and have pretty good mid to high single-digit operating margins, which is quite fantastic for a retailer. So all things considered, if I were to throw in a sixth company here, I'd say Lewis would probably be one that I would look at. So as we're coming to the end, just a quick mention, couple thoughts on dividends. Dividends are typically very inefficient forms of income relative to capital gains. You are taxed twice on a dividend. First, the company pays tax on its earnings, and then you pay tax as an individual when you receive it. So there is an inefficiency there. There's also the foregone growth the company sacrifices to pay you the dividend. So if take what company had that ROIC? Take Bellwin, for instance. If Bellwin is able to compound capital, return on invested capital, at 15%, then for them to reinvest that in the business is probably higher than you would get if you were to go and look somewhere else, because for you would need to now find something that can return capital at 15% as well, whereas they can do it in growth. So dividends do carry that extra layer of inefficiency, which when you combine with tax does compound over time negatively. Finally, there's also unfortunately a pressure on management that dividends create. You have companies like Steinhoff, or interesting, even like occasionally the banks have, and this is obviously a financial services company, so different model entirely, but they have payout ratios of above 100%. So that means effectively they are taking money to give you the dividend. They're borrowing money to give you the dividend, which is not entirely sustainable, excluding the banks. I mean, it's a different model, but let's talk about a regular company. So Steinhoff was quite well known for taking on debt and to kind of upkeep with the dividend. This pressure on management also inhibits decision making, in my opinion. When you become worried about what shareholders are thinking and not, you can lose focus on the company and how the company is going to be doing. So that's coming to the end, and I told you that I would let you know which ones I own. Of all of these companies, the only ones that I'm personally long are Bellwin and Signia. That is it. I hope that everybody has a fantastic day. Thank you for listening. And that was 5 or 6 JSE dividend yielding companies.